team. So let's go ahead and talk about some of the verbiage that'll be used in forex and in trading. And so you want to get familiar with these terms. That way, if you're on the training session or trading session, or if you're in the community chat and you hear or see certain things when I give information on a trade setup, if I'm talking about a retrace or PA or SP or certain things like that, you'll know what I'm talking about and what I am referring to. And so let's go ahead and get started with a couple of things to jump out. First, we're gonna go so you may hear these terms, a scalp or scalper. A scalp is a short-term trade that you're looking to make profit fairly quick. We're talking minutes, typically under an hour. And so these are different trading styles. And this is something that you will need to figure out to see what type of trader you are. And so a scalper wants to get in the market and out of the market as quickly as possible and earn profit. An intraday trader exercises a little more patience because intraday means under 24 hours. And so your trade could be 1 or 2 hours. Your trade could be 7, 8 hours. It's intraday, meaning you're looking to seek a setup and earn profit within so many hours, but you want to close out your trade before the end of the day. Then we have a swing trader, where a swinger would want to hold a trade for days. So you're not looking to get into a trade and earn profit in minutes like a scalper. You're not seeking to get into a trade and be out of that trade within a few hours like an intraday trader. A swinger, you're looking to enter a trade at an optimum position on the chart and then hold that position for days until it reaches a certain destination and then cash out that trade or take profit, right? So that's going to be your trading styles right here. Next up, after trading styles, let's talk about just understanding some common terms, which would be, this is all going to be in regards to like profits. And so first off, we'll talk about pips. Pips are going to be a unit of measure that is a incremental amount to calculate the amount of movement that you see on a chart. And so if we are looking to place a trade, we want to take that trade and we're seeking a certain number of pips to earn profit. That number may be 50 pips, it may be 100 pips, it may be 10 pips, but that unit of measure is what's going to be used to calculate the distance of the move that was made on the chart. That unit of measure is going to also be made to calculate what you are trading with, meaning each pip is going to be worth a certain dollar value. So you need to be trading with a dollar value representation, which would be your lot size. And so the pips are important because that move is going to determine what you can earn and how far of a move the market just gave. And then also it's going to determine the lot size that you can trade with. And then when you tie all of that together, it's going to give you your profit. And so now let's go into lot size, which is going to be the amount of money that you can trade with per pip. So your lot size is going to determine your profits. If you are trading at $1 a pip, the market moves 10 pips. You multiply 10 pips times $1, $10 is your profit. If your lot size is $10, you multiply $10 times 10 pips, that would be $100 for your profit. Right? And so that's pips, the unit of measure used to calculate the movement. Lot size is the unit of measure used to calculate the amount of money that you are placing into the market. TP is going to be take profit. Whenever you take a trade, you are looking to take profit. You are looking to earn profit. TP is the acronym for take profit. When you're placing a trade, you will have three things. TP is one, which will be your take profit. The entry is another, which would be where you are seeking to enter the market, the line number that you are seeking to place a trade from at that particular point on the chart. So when you're taking a trade, your three components are going to be your entry, your take profit, and then your stop loss, which is going to be SL. SL is your stop loss. And so whenever you place a trade, you have your three components: entry, stop loss, take profit. Your stop loss, take profit, all of that is going to be determined by the pip count and then the lot size. So you have to know this information, as this is vital for you to be able to place a trade, and not only place a trade, but make money in the market. And so whenever you're taking a trade, you will hear risk. Risk is associated with the stop loss. From your entry to the stop loss is the amount of money that you are willing to risk on a trade. Every time you place a trade, you will risk one number, which should be a small percent of your account, and then you will seek to reward yourself with the take profit, which would be the profitable portion of the trade if the market moves in anticipation of the direction that you are seeking a trade to enter and place in the market. And so this will bring us to the next term, which you will see a lot. You will see RR. That is risk to reward, because risk to reward is what we look at to see if we want to place a trade or not. If a trade setup is profitable, then we'll take that trade and we'll seek risk to reward. So let's see what this looks like on a chart here for a second. So we have a risk to reward tool, which is this right here, risk to reward tool. The risk to reward tool will identify the entry, which is right here. It will identify the stop loss, and it will identify the profit. And so this red area would be your risk area. And then this area would be your profit area. And then this line would be your take profit, your TP, which is your goal that you're seeking on this trade. And so whenever you are looking to take a trade, you want to calculate to make sure that whatever you are risking is going to pay you a nice profit. That is where this becomes a handy tool, because it'll let you know, hey, your risk to reward is 2 to 1. Therefore, if you are risking $50 on this trade, your profit will pay you $100. So you're risking $50 for the trade, but once you take profit, you'll get paid $100. So you'll get back double what you're investing. Okay, risk to reward. And so that's that. Let's jump back. So we have trading styles covered, profits covered. Now let's jump into some other stuff, right? Once we get going. Also, SP, that'll be stop profit. Stop profit. A stop profit is when you are in a trade, your trade is in profit, meaning you have gotten entry and your trade is now in profit. You can then reduce the amount of risk associated with that trade by moving your stop loss into profit, which would then create a stop profit instead of a stop loss. So SP, stop profit. Okay, you'll see that a ton. Right now, let's go into more of chart terminology, chart verbiage. And so this is going to be, you'll hear terms like this, RR again. Well, in the charts, when we're looking at RR, it's going to be railroad instead of risk to reward. From a profit standpoint, it's going to be RR, is going to be railroad from a chart standpoint, right? And so you'll have RR for railroad. You'll also have SL for swing low, SL for swing low. Then you'll have SH for swing high. Then you'll have PA for price action. Price action is going to be the movement of the candles, the movement of price on the chart. They will make patterns. Those patterns are called price action. Then the candles are going to be rectangular bodies that are on the chart that represent price movement during a certain duration of time. So if you are on the 1 hour chart, one candle will represent the movement of price for that 1 hour time frame. If you're on the 4 hour chart, one candle will represent the movement of price during that 4 hour time frame. Right, so that's your candles. Also associated with your candles, when you break it down, you'll have the body of the candle, which is the solid color of the candle, the solid portion of the candle, which will be a solid rectangle or square, kind of depending on the shape or length of the candle. And then also it is composed of wicks. Wicks will represent where price moved to, but did not stay. So that's the anatomy of a candle. From that, we can go into bull, which would be a bullish candle. A bullish candle will be one color. And then you will also have a bear, which is a bearish candle, which would be the opposite color. You only have two candles, two colors on your chart. So your bull candle will be a certain color. Your bear candle will be a certain color. Those colors will represent market participants. Those market participants will be either buyers or sellers. And so associated with your buyers and your sellers, which are your market participants, if the market is going down, then you may hear terms of the market being, bearish because the market is going down. If the market is going up, you will hear terms of the market is bullish, it's going up. And so bullish will be a uptrend. Bearish will be a downtrend. Right. Also, with this, you will hear terms like support, which is a buy zone where buyers are in the market in that area, that particular section of the chart, we would call like a demand zone, buy zone, because that's an area on the chart where market participants are looking to place buy orders. And then the opposite of that, you would have resistance, which is going to be a supply zone, sell zone, which is where sellers are in the market seeking to place sell orders at that particular point on the chart. And so the way that you identify these areas, these zones on a chart is with what we would call structure. And I'm going to get into that in a second, but I just want to cover these areas, these points on a chart before we move forward. And so if we look at a railroad will be right here. This is an example of a bearish railroad. It will be a bull candle followed by a bear candle. Bull candle followed by a bear candle. This would be the example of a bullish railroad, which is a bear candle followed by a bull candle. So railroads, bearish railroad, bull candle followed by a bear candle, bullish railroad, a bear candle followed by a bull candle. Then we could look at a swing high and a swing low. A swing high would be this candle here, this candle pair. It's going to be multiple candles. And then a swing low would be this candle here. And so what that means is when you have a swing high and a swing low, that means that you have one candle that is lower than, for a swing low, you have two candles above this candle, and then you have three candles above this one candle. So at that point, you have a swing low because you now have candles above this one candle that's down here by itself. The market has left. And so this is a swing low. Swing high is going to be the same thing, but opposite. If you look at this one candle here, it's a cluster of candles, okay? So you take that one candle, which is right here, you take the body of that candle, you have 1, 2, 3 candles lower on the left of that one candle, and then you have 1, 2, 3 candles that have printed lower as well on the right side of that candle. So this candle will be a swing high, and then the other candle that we were looking at, which was this one, would be the swing low, right? So now we can look at supply and demand zones. If we look here, we can see that the market has stopped here and made numerous railroads. Bullish railroad here, bullish railroad here, bullish railroad here. This is obviously a demand zone, a support where the market is placing a ton of buy orders. This would be the opposite, which would be a sell zone. We can obviously see bearish railroads all at the top. And so now the market has identified a supply zone. So this is where everyone is putting in sell orders. So if you want to buy, you need to buy here. If you want to sell, you need to sell here. If you're looking to cash out on a trade, to TP on a trade, take profit. If you are selling, you would want to take profit at the area on the chart where buyers are getting into the market. So therefore, you would take your sell, enter the trade here, and then you would cash out here. So that would be your risk to reward for your sale, 3-to-1. If you are looking to buy, you would want to buy here and cash out here, TP here, which will be the same risk to reward, a 3-to-1. It's the same zone. So these candles represent your buyers and your sellers. My blue candles represent my buyers. My red candles represent my sellers. And so this will represent time for this one candle. The time duration of price increased this number of pips during that one candle. Same thing for this bear candle. The market moved X number of pips during the time duration of this one candle from the body. So when we're looking at candles, we have the body of the candle. Then we'll have, which is the solid portion, solid red, the rectangle. Then we'll have the wicks of the candle. And then we can see another wick here. So we have wick, wick, and then we have the body of the candle. Right? And so that's going to be it for the candles. And so now we can look at some other terms, which would be used trading. And it's going to be more terms in regards to structure. Okay, where like your support, resistance, things like that, people will term that as structure. And so also you're going to have different things that'll happen. And so structure is going to be patterns that form in the market via your like support, demand zones, resistance, supply zones. Those zones will create structure in the market. Those patterns from structure is what we trade. And so these patterns are going to do certain things like create what we call POI, which will be points of interest. Those points of interest are going to be spots or line numbers on the chart where we would seek to place a trade, place an entry, where we would want to seek placing a trade. And then we're going to look at what we would call a teacup as well. A teacup is going to be a place on the chart where the market has created a pattern, created some type of movement. And when that movement has been made, we will seek for the market to duplicate that movement and create a W or a M. A W would be for a buy, a M would be for a sell. And so when we look at this on a chart and we're talking about teacups, we're going to look for the market to give a move, for the market to show a move, for the market to identify the origin and the end point of that move. Once we can identify the origin or the end point of that move, we can then seek to place a trade and enter for the market to duplicate that move. The market does these patterns all the time. And so, for example of what that would look like, let me go to a different time frame so we can see more movement. And so if we look here, we can see that the market was at this area. We have a swing low. And from this area, the market gave a nice push. A huge bullish push happened from this area. So if we want to get into this trade, if we are seeking to place an entry on this trade, we want to enter at the bottom of this move because this is where all of the buyers live. This is where the demand zone is. And so from this, you would be looking to place your entry here for your buy, and that will create what we would call a W. So the first leg is here. This bullish move would be the first leg of the W. This move here would be the second leg of the W. And so a teacup would look like this. We got this huge push from this area. We would expect the market to duplicate that, come back to the area, and go up. And so this will be a bullish teacup for a buy entry. A bearish teacup will be the opposite. The market was at this area. We have a swing high, and then from this area, the market pushes down. So this would be the first leg of the W, not W, sorry. We just did that. First leg of the M. And so now we would look for the market to return back to the origin where the first leg begun, which would be here, and then we would seek a sell entry to sell it down. And as you can see, the market gave the sell entry and the market did drop. And so that would be the second leg of the M pattern, which will be a teacup, but a bearish teacup for the sell. And so whenever we see certain patterns present itself in the market, we have a couple of ways to place orders and seek entry into that trade. So we could use tools like a fib tool, which would measure the drop. It would measure the push that the market gave to the downside from the origin. And then we would seek an entry somewhere near the origin so that we can catch the teacup entry for the sell down. And so once the market presents the pattern for the first leg, you could place what we would call a pending order. Right? Fib is going to be Fibonacci. That's what Fib stands for. And so we'll jump over here for the last couple. And for pending orders, we have limits, sell or buy limits, and then we'll have stop orders, which are sell stops or buy stops, and that's pending orders. Or you can enter the trade manually with a manual order by simply just clicking sell or buy and placing your trade. Most of the trades that we take, they will rarely be manual orders. We always will use pending orders because we are price action traders. And so we have to wait for the market to show us something. Then we place an order after we see what the market is doing, how the market participants are pushing the market. Once we see how they're pushing the market, then we get in on what we will call a retrace, which is another term. And that retrace is what the field represents. And that's what we use to place trades. But the retrace is going to be, it could be a couple of different things. Okay, a retrace could be a pullback. And so you could call it a retrace, you could call it a pullback, they mean the same thing. All it means is the market gave a move, gave a push, and then after giving that push, the market pulls back. And so it would look like this on a chart. So if we saw a push happen in the market where the market was going sideways here, and then after going sideways, at this point, the market decided to push down, shift downward. And so once that market shift downward, you could look to place a trade at the origin on the retrace. So the retrace would be after this bearish push, the market retraced with bull candles covering this move, coming back on this move. And so the push was over 100 pips, and then the market retraced over 100 pips. And so literally this entire push was taken away on the retrace. Okay, so retrace, that's what that term is. And it's important because that's what we use a lot, the way we trade. And so you'll hear also, as far as retraces, pullbacks, and things like that, you'll hear the way we trade, which is going to be our entry methods. You'll hear QB, which is for quarterback. It's a certain way that we trade the retrace. So you'll hear quarterback a lot. You'll also hear imbalance. You'll hear that a lot. It's a certain thing that we use to spot potential areas where we could place a trade or place an order. Also, you'll hear maybe a fair value gap, which is going to represent a point of interest, some type of area on the chart where we may look to place an order, place a trade, have a pending order waiting. You'll also hear breakout, which is a term that we use, and that's for one of our entry methods, which is called the bar. And so these are things that we use for placing trades and entry methods that we have pertaining to the way that we trade and the things that we do within our organization. All right, and so that will conclude the video for forex common language. Obviously, this is a lot of material. You're going to have to, write this down, take notes, and get familiar with it so that you can get acclimated with the verbiage and what we're using and what we're speaking of as we're looking and going over charts. All right. Thank you all for watching. Enjoy your day, and you all have a good one.